Samsung just made an announcement that got buried under AI headlines and earnings calls. Nobody noticed. That's a mistake. Their new solid-state battery requires 20 times more silver than current lithium-ion technology. Not a little more. 20 times. Do the math. If Samsung captures even 15% of the EV battery market by 2030, that's 16,000 tons of new silver demand every year. The entire world only mines 26,000 tons annually. And here's the thing. Mining supply hasn't grown in a decade. It's actually declining. Now look at what's already happening. COMEX registered silver inventories are at the lowest levels since records began. The London Bullion Market Association just revised its storage numbers, and 400 million ounces simply vanished from their accounting. India imported more silver in 6 months than they normally do in 2 years. Industrial demand hit a record. Solar panel manufacturers are scrambling. Electronics companies are hoarding. And Samsung just announced they need more silver than the entire jewelry industry consumes globally. This isn't a supply squeeze, this is a structural break, the kind that happens once every 50 years. And the last time it happened, silver went from $5 to $50. In March 2020, Samsung SDI published a paper in Nature Energy that changed everything about how batteries will be made, and almost nobody noticed. The paper described a new solid-state battery design using a silver-carbon composite layer just 5 micrometers thick at the anode. This tiny layer solves the biggest problem in battery technology, dendrite formation, those microscopic spikes that grow inside batteries and eventually kill them. Samsung's solution delivers 900 watt-hours per liter. That is 40% higher energy density than anything on the market today. It charges from 8% to 80% in 9 minutes. It lasts for over 1,000 cycles, and it requires roughly 1 kilogram of silver per vehicle. Now let me put that in perspective. A conventional lithium-ion battery uses between 25 and 50 grams of silver, mostly in the electronics around the battery, not in the cells themselves. Samsung's solid-state design uses 20 times more. 20 times. And here's the part that should make you pay very close attention. Samsung announced mass production for 2027. That is not a research target. That is not a maybe someday. That is a production timeline from one of the largest battery manufacturers on Earth. The financial media completely missed this story. They were busy covering AI chips and meme stocks and whatever Elon Musk tweeted that morning. Bloomberg mentioned it once. CNBC ignored it entirely. The Wall Street Journal ran a brief technology piece that focused on charging speeds and said nothing about silver. This is what happens when journalists do not understand materials science. They see a battery announcement and think faster charging times. They do not think about what goes into the battery. They do not ask where the raw materials come from. They do not calculate what happens when millions of vehicles need a material the world barely produces enough of. Let me tell you about silver, because most people do not actually understand what this metal is. Silver has the highest electrical conductivity of any element on the periodic table. Higher than copper, higher than gold. It has the highest thermal conductivity of any metal. It reflects 95% of visible light. It is naturally antibacterial, which is why it is used in medical equipment and water purification. These are not marginal advantages. These are fundamental physical properties that cannot be engineered around. When you need the absolute best conductor of electricity, you use silver. There is no substitute. Now here's the critical distinction I need you to understand, because this is where most investors get confused. There is a difference between a price movement and a structural shift. A price movement is temporary. Oil spikes because of a hurricane in the Gulf. Wheat jumps because of a drought in Kansas. These are supply disruptions that markets absorb and prices normalize. A structural shift is permanent. It is when the fundamental relationship between supply and demand changes in a way that cannot reverse. It is when a new source of demand appears that will only grow larger over time. We have seen this before. In 2009 and 2010, the solar panel industry started scaling up, and solar panels need silver for their electrical contacts. Not a lot per panel, about 20 grams, but the industry was installing millions of panels. Between 2009 and 2011, solar silver demand tripled. The silver price went from $9 to nearly $50, 5 times higher in 2 years, and that was from an industry consuming maybe 50 million ounces annually. Samsung's solid-state batteries at scale could consume 500 million ounces, 10 times the solar demand that caused a 5-fold price increase. But the solar parallel is not even the most important part of this story. The most important part is what has changed in the silver market since 2011. Back then there was slack in the system. Mines could increase production, inventory levels were high, recycling could fill gaps. None of that is true anymore. The silver market today is a completely different animal, and that brings us to something that almost nobody is talking about, the supply side of this equation, which is where this story goes from interesting to genuinely alarming. Here's the part of the silver story that almost nobody understands, and it is the reason this situation cannot be fixed by market forces alone. Silver is not like gold or copper or iron ore. You cannot just decide to mine more silver when prices go up. 72% of all silver produced on Earth comes as a byproduct of mining other metals. Copper mines produce silver, lead mines produce silver, zinc mines produce silver, gold mines produce silver. Only 28% comes from dedicated primary silver mines. Think about what that means. If silver prices double tomorrow, the copper mining companies do not suddenly produce more copper just to get at the silver. They produce copper based on copper demand and copper prices. The silver just comes along for the ride. You cannot increase silver supply without increasing copper supply, and copper supply is determined by completely different economic forces. This is a structural constraint that cannot be engineered around, and it gets worse. Primary silver mines, the ones that actually target silver as their main product, are depleting faster than new ones are being developed. Mexico has been the world's largest silver producer for over a century. In 2024, Mexican silver output fell again. Peru, the number 2 producer, has been dealing with political instability and environmental protests that have shut down operations. China, number 3, just announced export restrictions on silver effective January 2026 as part of their strategic minerals policy. The 3 largest producers are all facing constraints at the exact moment demand is accelerating. Now let me tell you about ore grades, because this is where the math becomes truly disturbing. Ore grade measures how much silver you get per ton of rock you pull out of the ground. In 2010, the average primary silver mine was processing ore with about 15 ounces of silver per ton. Today, that number is closer to 5 ounces per ton at many major operations. That is a 60% decline in just 14 years. What this means is that mines have to move 3 times as much rock to get the same amount of silver. That requires 3 times the energy, 3 times the equipment, 3 times the labor, 3 times the environmental impact. Mining costs have exploded while output has stagnated. And here's the timeline problem. Say you discovered a major new silver deposit tomorrow, the biggest find in 50 years. How long before that silver reaches the market? 10 to 15 years minimum. You need geological surveys, environmental impact studies, permits from multiple government agencies, financing that often exceeds $1 billion, construction of processing facilities, roads, power infrastructure, worker housing. The Pascua-Lama project on the Chile-Argentina border was discovered in 1977 and still has not produced a single ounce of commercial silver. The pipeline of new supply is nearly empty because there have been no major silver discoveries in decades. Exploration budgets were gutted after silver crashed in 2011 and they never recovered. The deposits being mined today were discovered in the 1980s and 1990s. When those run out, there is almost nothing behind them. Now let me show you the math on supply and demand, because the numbers tell a story the market has not yet priced in. Global silver mining produces approximately 820 million ounces per year, roughly 25,500 tons. Industrial demand alone consumed 680 million ounces in 2024, that is about 21,000 tons, and it is growing at 5 to 7% annually. Add jewelry and silverware at around 6,000 tons. Add investment demand, which varies but has been running over 200 million ounces in recent years. Add the silver that goes into photography and brazing and other applications. Total it up, and demand exceeds supply by somewhere between 150 and 250 million ounces every single year. The market has been in structural deficit for 5 consecutive years. 5 years. The cumulative shortfall since 2021 is approximately 820 million ounces. That is roughly 10 months of total global mine production that has been consumed from existing inventories. Where does the silver come from when mines cannot produce enough? 2 sources. Recycling, which provides about 180 million ounces annually, but cannot scale quickly because most silver is used in ways that make recovery expensive or impossible. And inventory drawdowns, which means pulling silver out of vaults and warehouses and ETFs and anywhere else it sits. This is the critical point. Above ground silver stockpiles are finite. Every ounce that leaves a vault to fill the supply gap is an ounce that cannot fill next year's gap. The cushion is shrinking. The buffer is depleting. The system is running on reserves that took decades to accumulate, and those reserves are draining at an accelerating pace. You cannot solve a structural supply deficit with price increases. Higher silver prices do not create more copper mines. Higher silver prices do not accelerate permitting timelines. Higher silver prices do not regenerate depleted ore grades. Higher silver prices do not make new discoveries appear. The supply side of this market is constrained by geology and physics and bureaucracy, forces that do not respond to price signals the way economic models assume. And this is before a single Samsung solid-state battery rolls off the production line. Now that you understand the supply constraints, let me walk you through what is happening on the demand side, because this is where the situation goes from concerning to mathematically unavoidable. I am going to take you through each major demand category one by one, and by the end, you will see why the silver market is heading towards something it has never experienced before. Let us start with solar panels, because this is the demand source that has already transformed the silver market over the past decade. Every solar panel needs silver for its electrical contacts. Silver paste creates the tiny conductive lines that collect electrons from the silicon cells and channel them into usable electricity. You cannot use copper because copper oxidizes and degrades panel efficiency within months. You cannot use gold because the economics do not work at scale. Silver is the only metal with the conductivity and durability to make solar panels function for their 25-year lifespan. Each gigawatt of solar capacity requires approximately 20 tons of silver. In 2024, the world installed over 400 gigawatts of new solar capacity. That is 8,000 tons of silver just for solar, roughly one-third of total annual mine production going into a single application. And here is what the thrifting narrative gets wrong. The solar industry has been trying to reduce silver content per panel for years. They have made some progress on older technology, but the newer high-efficiency panels, the TOPCon and heterojunction designs that everyone is racing to adopt, actually use more silver, not less. These next-generation panels require 1.5 to 2.4 times the silver loading of standard PERC cells. The industry is getting more efficient at converting sunlight to electricity, but less efficient at conserving silver. China alone installed over 200 gigawatts of solar in 2024. Their stated goal is to reach 1,200 gigawatts of solar capacity by 2030. That build-out alone could consume 12,000 to 15,000 tons of silver, roughly half of annual global production, for one country doing one thing. Now add electric vehicles. A conventional gasoline car uses about 15 grams of silver in various electrical components. An electric vehicle uses between 25 and 50 grams, roughly 2 to 3 times as much. This silver goes into battery management systems, power electronics, charging ports, electric motor contacts, and the hundreds of sensors and connections that make an EV function. Global EV sales exceeded 14 million units in 2024 and are projected to reach 40 million by 2030. At 35 grams average silver content, that is 1,400 tons today, growing to 4,000 tons annually by end of decade. But that calculation assumes lithium-ion batteries. Samsung's solid-state design uses 1 kilogram per vehicle, not 35 grams. If solid-state batteries capture even 10% of the EV market by 2030, you add another 4,000 tons of demand on top of the lithium-ion baseline. Now add 5G infrastructure. Every 5G base station requires between 50 and 100 grams of silver, 3 to 5 times more than 4G equipment. Why? Because 5G operates at higher frequencies that demand better conductivity. Silver's unmatched electrical properties become more critical, not less, as technology advances. The world is deploying millions of these base stations. China alone has installed over 3 million 5G towers. The United States and Europe are racing to catch up. Industry projections put 5G silver demand at 23 million ounces by 2030, roughly 700 tons annually just for cell towers. Now add artificial intelligence infrastructure. This is the demand source that has received the least attention, but may prove the most significant. Every AI server requires silver in its connections, its thermal management systems, its high-frequency components. AI data centers consume 2 to 3 times more silver per square foot than traditional facilities because AI chips run hotter, process faster, and require more sophisticated cooling and connectivity. The AI build-out is just beginning. NVIDIA cannot produce chips fast enough. Microsoft, Google, Amazon, and Meta are spending tens of billions annually on data center expansion. Each new facility is a silver sink that did not exist 5 years ago. Now add medical devices and antibacterial applications. Silver's natural antimicrobial properties make it essential in wound dressings, surgical instruments, catheters, and hospital surfaces. The COVID pandemic accelerated adoption of silver-based antimicrobial coatings. This is a smaller category, perhaps 50 million ounces annually, but it is growing steadily, and the silver cannot be easily recycled from these applications. Now let me bring Samsung back into focus and explain why their solid-state battery is not just another demand source, but a potential market-breaking event. Samsung's technology uses a silver-carbon composite at the anode interface. The silver serves as a lithophilic layer, meaning it attracts lithium ions and guides them to deposit evenly rather than forming the dendrites that kill conventional batteries. This is not a design choice that can be easily substituted. Silver's unique combination of electrical conductivity, chemical stability, and lithophilic properties makes it ideal for this application. Other materials have been tried. None match silver's performance. Let me walk through the math that precious metals analysts have been quietly calculating. Samsung SDI produces batteries for BMW, Volkswagen, Stellantis, and other major automakers. If Samsung captures 15% of the global EV battery market by 2030, and 15% of 40 million vehicles is 6 million units, and each unit requires 1 kilogram of silver, that is 6,000 tons of new annual demand from a single company's single product line. The more aggressive projections assume 20% market capture. That puts the number at 8,000 tons. Some analysts project 16,000 tons if you include Samsung's competitors who may adopt similar silver-based designs. I want to be clear about something important here. Not every solid-state battery company is using silver. Toyota, which holds more solid-state patents than anyone else, uses a sulfide electrolyte that contains no silver. QuantumScape uses a ceramic separator with no silver. If these alternative approaches win the technology race, the battery demand scenario changes dramatically. But Samsung is not a small player betting on an unlikely technology. They are one of the largest battery manufacturers on Earth, with existing relationships with major automakers and a production timeline that is years ahead of competitors. Even if Samsung only captures 10% of the market, even if their technology remains a niche application rather than industry standard, you are still adding thousands of tons of new demand to a market that is already in structural deficit. Now let me show you the cumulative picture, because this is where the math becomes genuinely alarming. Current annual silver supply sits around 2,500 tons, including mining and recycling. Current demand already exceeds supply, creating an annual deficit of roughly 5,000 to 7,000 tons. Solar demand is growing at 15% annually. EV demand is growing at 20% annually. 5G and AI demand is accelerating from a small base. Medical and industrial applications continue steady growth. Each one of these demand sources would be significant on its own. Solar alone has fundamentally changed the silver market. EVs alone would create supply pressure. AI infrastructure alone represents a new category consuming hundreds of tons annually. Together, they are creating something the silver market has never experienced, a demand surge across multiple sectors simultaneously, all hitting at the exact moment when supply is constrained by geology, depleted ore grades, and decade-long development timelines. The gap between supply and demand is not narrowing. It is widening. Every year the deficit grows larger. Every year more silver leaves vaults and warehouses to fill that gap. Every year the buffer shrinks. And somewhere in 2027, if Samsung's production timeline holds, a new demand source larger than anything the market has absorbed in decades will switch on and start consuming silver at industrial scale. There are only two ways this resolves. Either prices rise high enough to destroy demand, meaning solar installations slow, EV adoption stalls, AI build-outs pause, and Samsung finds an alternative material, or demand continues and silver simply becomes unavailable at any price for some applications. History suggests the answer will be some combination of both. Prices spike dramatically and shortages emerge simultaneously. That is the pattern. That is what happened in 1980. That is what happened in 2011. And the setup today is more extreme than either of those episodes. Everything I have told you so far is about fundamentals, supply constraints, and demand growth and structural deficits. But fundamentals do not move markets until they do. What moves markets is when enough people recognize the fundamentals and start positioning accordingly. So let me show you the signals that tell us the smart money is already moving, because these signals are flashing everywhere if you know where to look. Start with COMEX, the primary futures exchange where silver is traded in the United States. COMEX maintains two categories of silver inventory, eligible and registered. Eligible silver is stored in COMEX-approved vaults, but is not available for delivery against futures contracts. Registered silver is the metal that can actually be delivered when someone demands physical settlement. In 2021, COMEX held approximately 115 million ounces of registered silver. Today, that number sits around 35 million ounces. That is a decline of nearly 70% in 4 years. Let me explain why this matters. For every ounce of registered silver sitting in COMEX vaults, there are between 17 and 28 ounces worth of paper claims trading as futures contracts. The exact ratio depends on how you count, but the direction is unmistakable. There are far more promises of silver than there is actual silver available to fulfill those promises. This works fine as long as most traders are speculators who never want physical delivery. They buy contracts, prices move, they sell contracts and settle in cash. The metal never moves. But when industrial users or large investors start demanding actual delivery, when they say, "I do not want cash, I want my silver," the system faces a problem it was not designed to handle. Now look at what happened in London. The LBMA, London Bullion Market Association, operates the largest physical precious metals market in the world. In early 2025, they revised their vault holding data, and approximately 400 million ounces of silver that was previously reported simply vanished from their accounting. The official explanation involved changes to reporting methodology. The practical reality is that London vaults hold less silver than markets previously assumed. When the cushion you thought existed turns out to be smaller than reported, the margin for error disappears. February 14, 2025, something unprecedented happened in South Korea. The Korea Gold Exchange notified major banks including KB Kookmin, Shinhan, Woori, and NH Nonghyup that silver bar supplies were suspended effective immediately, not next month, not after current inventory sells through, immediately. These banks had been selling silver to retail customers for years without issue. Suddenly they could not source physical metal at prices that made retail sales viable. They were not raising prices or limiting quantities, they simply stopped selling entirely and announced the suspension would last until at least January 2026. This is what happens when paper prices and physical availability diverge. Banks can quote the COMEX price all day long, but if they cannot actually acquire silver to deliver to customers, the quoted price becomes meaningless. They stopped selling because they could not source the metal. India imported 7,669 tons of silver in 2024, more than double the prior year and the highest level in at least a decade. Nearly half came through the UAE, exploiting preferential trade agreements to arbitrage price differences between markets. Indian buyers are paying premium prices and absorbing physical silver at a rate that is draining global supplies. This is not investment speculation. This is industrial demand from a country racing to build solar manufacturing capacity and electrical infrastructure. China announced in November 2025 that silver would be added to their list of tightly controlled exports effective January 2026. China processes the majority of global silver ore, the semi-refined material that comes from mines before final processing. These export restrictions could affect 60 to 70% of refined silver flowing to Western markets. China is not doing this because they have surplus silver. They are doing this because they need every ounce for their own industrial consumption, and they are willing to disrupt global supply chains to secure it. Now let me explain backwardation because this is the clearest signal that physical markets are breaking from paper markets. Normally, futures contracts for delivery months from now trade at a premium to spot prices. This is called contango, and it reflects storage costs, insurance, and the time value of money. You pay a little more to lock in a future price. Backwardation is the opposite. It is when spot prices, the price for immediate delivery, exceed futures prices. In plain English, it means buyers are paying more to get silver today than to get a promise of silver tomorrow. That is panic buying. That is a market saying, "I do not trust that silver will be available later, so I am paying a premium to get it now." In October 2025, silver entered deep backwardation with front-month contracts trading nearly $3 above later-dated contracts. That was the steepest inversion since 1980. At the same time, silver lease rates, the cost to borrow physical silver, spiked to 32%. Normal lease rates run below 1%. A 32% lease rate means holders of physical silver can earn extraordinary returns simply by lending their metal because borrowers are desperate to source it. These are not normal market conditions. These are stress signals from a market that is struggling to function. Let me tell you about the last 2 times silver markets experienced this kind of stress because history shows us how these situations resolve. In 1979 and 1980, Nelson Bunker Hunt and his brother William Herbert Hunt accumulated over 100 million ounces of physical silver, plus another 90 million ounces in futures contracts. They controlled roughly 1/3 of the non-government global supply. Silver prices went from $6 to nearly $50 in less than a year. The Hunts were not responding to industrial demand. They were speculating on inflation and attempting to corner the market. When COMEX changed the rules, implementing position limits and requiring nearly 100% cash margins, the squeeze collapsed. Silver crashed from $21 to under $11 in a single day on what became known as Silver Thursday. The Hunts eventually declared bankruptcy. In 2011, silver again approached $50, driven by a combination of solar demand growth, investment buying, and post-financial crisis monetary policy. The CME Group responded with 5 consecutive margin increases in 9 days, raising requirements by 84%. Silver crashed from $49 to $33 within days. Both episodes ended with regulatory intervention, crushing speculative positions through margin manipulation. But here is what is different this time. The current silver market is not being driven by speculators trying to corner the market. It is being driven by industrial users who need the metal to manufacture products. Solar panel factories cannot simply exit their silver positions when margin requirements rise. They need the silver or they shut down. Samsung cannot abandon their solid-state battery program because COMEX raises margins. They either source the silver or they do not produce batteries. When demand is speculative, margin increases work because speculators can walk away. When demand is industrial, margin increases do not destroy demand. They just change who gets the available supply. The factories with the deepest pockets and the most critical need outbid everyone else. Prices do not crash, they spike higher as industrial users pay whatever is necessary. Now look at who is positioning for what comes next. Mining companies, the entities that should theoretically benefit most from higher silver prices, are not expanding production capacity. They are not announcing new projects. They are not raising capital for development. Instead, they are paying dividends and buying back shares. Why would companies with rising commodity prices not invest in growth? Because they understand that new supply takes a decade to develop, and ore grades are depleting faster than discoveries can replace them. They are harvesting existing deposits rather than investing in expensive, uncertain future production. Central banks in Russia and China have been accumulating precious metals for years while simultaneously selling U.S. Treasury holdings. They are not announcing silver purchases the way they announce gold purchases, but the export restrictions and domestic hoarding tell you everything about their priorities. Industrial users are quietly stockpiling. When you run a solar panel factory or an electronics manufacturer, you do not wait for prices to spike to secure critical inputs. You build inventory when you can source material, you sign long-term supply contracts, you do whatever is necessary to ensure continuity of production. The users who understand the supply picture are not waiting for the market to figure it out. And in the options market, large positions are building in out of the money calls, bets that silver will trade dramatically higher. Someone is paying for the right to buy silver at $60, $70, even $100 per ounce in the next 12 to 18 months. Retail investors do not typically make those trades. The size and structure suggest institutional money positioning for a price move that would seem absurd based on current spot prices, but makes perfect sense if you understand the supply and demand math I have been walking you through. When physical markets and paper markets diverge, physical markets always win. They win slowly at first as discrepancies build and stress signals multiply and smart money quietly repositions. Then they win all at once as the gap between promises and reality becomes too large to ignore and prices reset to reflect what the physical market knew all along. Let me tie everything together and show you the pattern, because once you see it, you cannot unsee it. There are 4 stages to a commodity supply crisis, and they play out the same way every single time. Stage 1 is structural supply-demand imbalance. This is when consumption begins exceeding production, not because of a temporary disruption, but because of fundamental changes in either supply or demand or both. In silver, we have both. Supply is constrained by byproduct economics, depleting ore grades, and decade-long development timelines. Demand is accelerating across solar, EVs, 5G, AI, and now potentially solid-state batteries. Stage 1 is not a prediction. It is documented fact. The Silver Institute, the mining industry's own research body, has published the data showing 5 consecutive years of structural deficit. Stage 1 check. Stage 2 is inventory drawdown. This is when the market masks the imbalance by depleting existing stockpiles. Prices stay stable because metal is still available, it is just coming from vaults instead of mines. COMEX registered silver has fallen from 115 million ounces to 35 million ounces. LBMA vault holdings are at multi-year lows. The cumulative deficit since 2021 equals roughly 820 million ounces, approximately 10 months of global mine production consumed from reserves that took decades to accumulate. The buffer is shrinking every month. Stage 2 check. Stage 3 is physical market stress signals. This is when the drawdown reaches levels that start affecting market function. Backwardation appears, lease rates spike, banks suspend sales because they cannot source metal. Industrial users pay premiums above official prices to secure guaranteed supply. Retail buyers encounter delays and shortages. We are in stage 3 right now. South Korean banks stopped selling in February. China announced export restrictions in November. Silver lease rates hit 32%, 32 times normal levels. Backwardation in October was the steepest since 1980. The stress signals are everywhere for anyone paying attention. Stage 3 current. Stage 4 is price discovery and supply failure. This is when the market can no longer pretend that paper prices reflect physical reality. Industrial users who need silver to run their factories start paying whatever is necessary to secure supply. Retail investors who want physical metal find it unavailable at any price at their local dealer. The paper market, the futures exchanges and ETFs loses credibility as participants realize the claims exceed the underlying metal by enormous multiples. Prices spike in ways that seem irrational to anyone who does not understand the previous three stages. To informed observers, the price moves are not irrational at all. They are the market finally acknowledging what the physical supply chain has known for years. Let me tell you what Stage 4 looks like when it arrives. Solar panel manufacturers will sign long-term contracts at prices 50 or 100% above current spot levels just to guarantee delivery. Electronics companies will stockpile years of inventory rather than risk production shutdowns. Samsung and other battery makers will secure supply through direct investments in mining companies or streaming agreements that bypass public markets entirely. The industrial users with deep pockets and critical needs will absorb available supply at premium prices. Everyone else will wait. Retail investors who walk into a coin shop expecting to buy silver eagles at a few dollars over spot will be told there is a 3-month waiting list or no availability at all. Online dealers will show out of stock notices on products that were abundant months earlier. Premiums for physical metal over paper prices will widen from the current 5 to 10% to 20, 30, 50% or more. This is not speculation. This is exactly what happened in 2020 during the initial COVID panic when silver spot prices showed one number and actual physical metal sold for 30 to 50% higher if you could find it at all. The difference is that 2020 was a temporary demand spike from retail investors. The current situation is a structural supply shortage being driven by industrial consumption that does not reverse when panic subsides. I am not going to tell you when Stage 4 arrives because timing markets is impossible, and anyone who claims certainty is lying. Markets can remain irrational longer than you can remain solvent. The silver market could muddle along for another year or two as creative sourcing and inventory drawdowns continue masking the deficit. Or a single large industrial buyer could trigger the transition next month by attempting to secure physical supply and size and discovering it does not exist at quoted prices. What I can tell you is that the structural forces are mathematical. You cannot consume more than you produce indefinitely. You cannot draw down inventories forever. At some point, the physical constraint becomes binding, and prices must adjust. Samsung's production timeline provides one forcing function. Their solid-state batteries enter mass production in 2027. If their technology succeeds, if automakers adopt it at scale, demand for silver increases by thousands of tons annually in a market already running deficits. That is 2 years away, not a decade. Not someday, maybe. 2 years until a potential step change in demand hits a supply chain that is already strained. Let me tell you about the Hunt brothers because their story contains the most important lesson about what not to do. Nelson and William Hunt saw the same fundamental picture in the late 1970s, inflation eroding the dollar, precious metals undervalued, supply constraints building. They were right about the fundamentals. They made billions as silver ran from $6 to $50. Then they lost everything. They used leverage, borrowing against their silver positions to buy more silver. They concentrated their entire fortune in a single trade. They believed they could corner the market and force prices even higher. When regulators changed the rules, when margin requirements spiked, their leveraged positions collapsed. They could not meet margin calls. They had to sell into a falling market. The price crashed and took them with it. The Hunts were destroyed not because they were wrong about silver, but because they were over-leveraged, over-concentrated, and overconfident. They confused being right about direction with being able to predict timing and magnitude. The people who made generational wealth in that same period did something different. They bought physical metal. They held without leverage. They did not try to maximize returns through futures contracts and margin. They simply owned silver and waited. When prices spiked, they had something to sell. When prices crashed, they still had their metal. They could wait for the next cycle without facing margin calls or forced liquidation. Patience and physical ownership beat leverage and speculation. This is the Irving Fisher versus Roger Babson choice. In 1929, Irving Fisher was the most celebrated economist in America. He declared that stocks had reached a permanently high plateau. He was leveraged to the hilt in the market. He lost everything in the crash and died in poverty trying to rebuild his reputation. Roger Babson saw the same data Fisher saw and reached the opposite conclusion. He warned of the coming crash. He was mocked and dismissed. He held cash and hard assets while everyone else was levered long. When the crash came, he was positioned to survive and thrive. He made a fortune. He founded a college that still exists today. The difference was not intelligence. Fisher was probably smarter. The difference was that Babson respected the pattern. He positioned for what was coming rather than what he wished would happen. I am not a financial advisor. I am not telling you what to buy or sell or when. I am a researcher who studies patterns, and the pattern here is clear. You have information now that most people do not have. You understand the supply constraints. You understand the demand acceleration. You understand the inventory drawdown. You understand the physical market stress signals. You understand the historical parallels and how they resolved. The question is not whether you believe me. The question is what you do with this information. If you want to research further, start with the Silver Institute's World Silver Survey. It is published annually and provides comprehensive supply and demand data. Look at COMEX inventory reports, which are updated daily. Track LBMA vault holdings. Follow the industrial demand data from solar and EV sectors. Read Samsung's published research on solid-state batteries. The data is public for anyone willing to look. The advantage you have is seeing the pattern early. The people who get hurt in supply crunches are not stupid. They are just late. They wait until the shortage is obvious, until prices have already spiked, until premiums have already exploded, and then they try to buy. By then, the easy money has been made and the risks have multiplied. The people who benefit are the ones who position before stage 4 arrives. They accept that timing is uncertain. They size their positions appropriately. They avoid leverage. They hold physical assets that cannot be margin called away. They wait. Samsung published their solid-state battery research in Nature Energy. Their production timeline targets 2027. Their technology requires roughly 1 kilogram of silver per vehicle. Most people still do not know this. The financial media has not connected the dots. The silver market has not priced in what happens when the world's largest battery manufacturers start competing with solar panel factories and electronics companies and medical device manufacturers for a metal the Earth produces only 820 million ounces of per year. Now you know. If this video helped you see something you did not see before, subscribe and turn on notifications. I am going to be breaking down each element of this story in more detail over the coming weeks. The solar demand picture, the solid-state battery technology race, the COMEX inventory situation, the historical parallels and what they teach us about timing. Knowledge is not power. Applied knowledge is power. The people who understood what was happening in silver in 1979 or 2010 had a window of opportunity to position before the rest of the market caught on. That window exists again right now. How long it stays open depends on how quickly information spreads, how fast industrial users secure supply, and when the physical market stress signals become impossible for paper markets to ignore. The pattern is clear. The data is public. The choice is yours.